This is Richard Walker from Lucidate. Welcome to the third video in this introductory series on interest rate swaps. If you've seen the first video, you will have seen why firms trade swaps, what a swap is, and how they help manage interest rate risk. We developed these concepts some more in the second video when we discussed how to price and risk manage a swap. We'll continue on that risk and analytic thread in this video when we discuss central clearing. We'll consider two types of risk, market risk and credit risk. Market risk is due to rate moves. If market rates move against you, you will suffer losses. Credit risk is due to a counterparty not paying. This is likely in the case of a bankruptcy or insolvency. Central clearing does not solve market risk, but it helps alleviate credit risk. For now, let's briefly look at both these types of risk. Swaps have large notionals. Tens or hundreds of millions of dollars, euros or sterling is perfectly normal. Swaps are long dated. Maturities of short dated swaps are measured in units of years. Long dated swaps measured in units of decades. The interest rate curve is not static. It steepens, it flattens, it shifts and twists. These changes in curve shape bring about changes in the discount rates and forward rates that drive the valuation of swaps, as we saw in the previous video. The combination of large notionals, long maturities and volatile interest rates means that swap valuations can and do change dramatically. This change in valuation in response to changing rates is the market risk that a swap participant is assuming. With large swings in valuations, large exposures can build up between swap participants. If one of your counterparties is unable to make good on their obligations to you, then you lose all those potential cash flows. This is credit risk, nothing to do with price volatility, rather that your counterparty will not or cannot pay. Of particular concern to policymakers and regulators is systemic credit risk. As we've discussed, banks are very active swap market participants. They manage their fixed and floating obligations and receivables across a range of maturities with swap contracts. Inevitably, they build up large swap positions with one another. Indeed, in many cases, they are relying on a swap receivable cash flow from one bank counterpart to pay an obligation to another. This creates a complex web of receivables and obligations. Under normal market circumstances, this creates some complexity, but as long as all counterparties are able to fulfill all of their payment obligations, then all is well. However, if a counterpart becomes insolvent and defaults, then this could set off a chain reaction of defaulting firms. If a bank of good standing is depending on a very large payment from the defaulting firm, then this bank may itself become insolvent. The market needs a circuit breaker to make sure that defaults are isolated and contained rather than becoming systemic. This is where clearing comes in. Rather than each counterparty keeping bilateral deals with every other firm, instead they only face a clearinghouse, or CCP. CCP here stands for Central Counterparty. The workflow to do this is frankly straightforward. First, two firms agree on a deal between themselves. Once the deal is agreed, the terms are relayed to the clearinghouse. The clearinghouse checks that the trade is eligible and checks that each counterparty has sufficient funds lodged with it. More on these funds lodged with the clearinghouse in a couple of minutes. And if all is good, it steps into the trade. The clearinghouse thus becomes an intermediary between each market participant. The CCP assumes no market risk. It is penny flat Each receivable is offset by a payment obligation and vice versa. But the clearinghouse does assume credit risk. Indeed, it assumes a vast amount of credit risk. If any of the parties default, it has to make good on that firm's obligations to everyone else. A CCP has no money of its own other than the fee income which it uses to pay staff and management. So, how can it make good on its obligations to surviving firms if one or more firms default? You may recall that a minute or so ago I said that the clearinghouse will perform checks before it accepts a trade. It will check that the trade is eligible. That is to say, it's in an appropriate currency and within an acceptable maturity limit. It will also check that each counterparty has sufficient funds lodged with the CCP. These funds are called initial margin, and they're one of several layers of defences that clearinghouses deploy to stave off systemic default risk. These layers are often referred to as a waterfall. That is to say, a cascading set of measures designed to provide non-defaulting firms with the cash flows that they are entitled to should one firm become insolvent, bankrupt, or otherwise unable to make good on that defaulted firm's obligations. To analyse the series of defences in the waterfall, let's first discuss what the CCP will do if a firm defaults. If a firm, or frankly multiple firms, do default, then their trades are transferred directly to the clearinghouse. At this point, the CCP is not penny flat. It owns live market risk from the defaulted firm's portfolios. You can think of the roles of the clearinghouse now as being split in two. It still assumes its CCP role, accepting eligible trades from surviving members, receiving and paying variation margin to its firms. But also, it's an active swap participant. Its sole trading objective is to neutralise the risk in the defaulter's portfolio that it has assumed. To do this, it will put on trades to neutralise the aggregate risk. For instance, if there's a large net paid position in 5-year euro rates, it will put on an offsetting 5-year euro receiver swap. Likewise, if there's a net 2-year receive position in US dollars, then it will execute a 2-year US dollar payer swap. These trades themselves will be cleared and will offset the risk in the defaulted portfolio. The result of these actions will be a risk-neutral portfolio that can be auctioned off to surviving members. So this describes the default management process if a firm defaults, but it doesn't explain how surviving firms are compensated for variation margin payments they would have received from the defaulting firm. Here is where we return to the layers of defence in the waterfall. The first layer of defence is credit due diligence. Not every firm will be able to join a clearinghouse. The credit officers of the CCP will analyse a prospective member's financial statements and audited accounts prior to allowing the firm to join. Once admitted as a member, the clearinghouse credit officers will continue to monitor and audit the financial health of that firm. The second layer of defence is called variation margin. At least once a day, all the swaps in members' portfolios are valued. This will result in gains and losses. Losses are paid to the clearinghouse and gains are paid out by the clearinghouse to member firms. As the clearinghouse is penny flat, the gains will exactly equal the losses to the penny. Thus, the clearinghouse is simply a pass-through agent for variation margin. This exchange of variation margin is crucial. It assures that large exposures cannot build up. If any firm should now default, then they've already paid up any losses to this point. Now we come to the initial margin that we spoke of earlier. This initial margin is a good faith deposit of funds held in escrow on behalf of the firm depositing the margin. Recall from a minute or so ago that if a firm defaults, then the clearinghouse will first neutralise and then auction off the resulting neutralised portfolio. Swap clearinghouses are afforded 5 days to do this. During that time, a defaulted firm's portfolio might suffer losses. Had the firm not defaulted, then it would be diligently paying its variation margin on these losses. As a defaulted firm, it clearly can't do that. But losses on this portfolio must mean gains for other members. This then is the purpose of initial margin, to pay surviving members' gains while the portfolio is being neutralised by the CCP. How much initial margin should the clearinghouse call for? The specific details will vary from clearinghouse to clearinghouse. Let's explore one approach for the clearinghouse to set the level of margin for each member. For interest rate swaps, clearinghouses are assumed to require 5 days to execute their default management trades to neutralise the risk in the defaulted portfolio. During this time, as in normal times, the surviving members are entitled to variation margin payments on profitable trades. It would therefore seem logical for the clearinghouse to hold enough margin from each member to cover 5 days of potential variation margin payments. Now, there are many ways to achieve this, but a common way is to use some sort of historic simulation. This involves using historic changes in zero coupon curve shape and revaluing each firm's portfolio to get a profit and loss distribution. That's a lot of words and a lot to take in. So let's unpack it piece by piece. The clearinghouse will keep a record of market data moves for a period of time. Let's say this period of time is 10 years. Using this data, the clearinghouse can calculate the valuation of each member's trades every day, 10 years. From this information, it can calculate the gains or losses over any 5-day period for the last 10 years. You could, should you wish, visualize this distribution of profit and loss in a histogram. On the horizontal axis, we plot gains and losses, with gains to the right and losses to the left. In the vertical axis, we plot frequency. That is to say, how many times we've seen a gain or loss of this amount. Most of the time, one would see small gains or small losses, as represented by this large area in the middle of the distribution. There will be a few, but very few, occasions where a swap portfolio makes very large gains, and these are shown on your screen. Of particular interest to us are historic large losses in the portfolio. We'll use this to set our margin. The losses are shown here. Let's say we take the worst 1% of losses. If we assume 260 business days in a year for 10 years, these will be the worst 26 losses that this portfolio would have experienced in the past 10 years over a 5-day period. We can therefore take an average of these losses and use this as a foundation for the amount of initial margin required. A clearinghouse could further increase this margin if the credit quality of the firm deteriorated, or if there were large concentrated risk positions in the portfolio. Different clearinghouses will have different algorithms, maybe 5 years worth of historical data, or perhaps taking an average of the worst 0.5% of losses. But I'm sure you get the idea. These approaches are a way of sizing the margin requirement by looking at worst case losses of this portfolio in recent history. Remember, these funds will be used to pay surviving members' variation margin gains while the clearinghouse is managing the defaulting member's portfolio. The next layer of defence is the clearinghouse's own funds, held back from the clearing fees that it generates. Usually, this is referred to as skin in the game. This is typically not a large amount, but it's there to incentivize the clearinghouse to behave in a prudent fashion. If its risk standards are too low, then it stands to lose its own capital. The final default waterfall layer we will consider here is the default fund. Please do bear in mind that many CCPs operate deeper waterfalls with additional protection. You will hear terms like partial tear-ups and variation margin gains haircutting. But for our purposes, we'll conclude with the default fund. In addition to posting initial margin, members will also be required to post default fund contributions. And once again, there are many ways to both calculate and allocate the default fund. So let's provide a simple example here. As discussed in the last video, we can shift, steepen, flatten, tweak and flex our zero coupon curves in any way we see fit. We can do this and come up with some extreme but plausible interest rate shifts. These won't be shifts we've necessarily seen in the market, as was definitely the case using historic simulation for our initial margin calculations earlier. But in extreme circumstances, these shifts could happen. This is a technique called stress testing. The risk committee of each CCP, normally comprised of clearinghouse risk managers as well as risk managers from member firms, will be tasked with coming up with a series of stress tests. The selection of stress tests will be overseen by regulators such as the Bank of England in the UK and the CFTC in the United States. Multiple tests are applied to all members' portfolios. An approach to sizing would be to take the two worst case losses. An approach to allocation among firms, i.e. how much each firm's default contribution is, might be a pro rata allocation based on each firm's current initial margin. Each clearinghouse will have their own approach. Thus, if it turns out that the defaulting member's initial margin was not enough to cover surviving members' variation margin payments, there are further resources, including CCP skin in the game, as well as the default fund from surviving members that can be deployed. So, let's pause and ponder for a while about some of the things we've discussed in this interest rate series. In the last video, we spoke about zero coupon curves, how they use a set of mathematical rules to transform prices of fixed income instruments into discount rates and forward rates. In the previous video to that, we discussed interest rate swaps. Swaps use a set of rules to transform a contract definition into a series of cash flows. In this video, we've discussed a clearinghouse. This uses a set of rules to calculate members' margin and to determine trade eligibility. It also uses a set of rules, some information from zero coupon curves and swap cash flows to value swaps and calculate daily variation margin. Hopefully, you see that all these structures can be written in smart contracts in Solidity. Once again, there's a valid discussion about whether this is desirable or not, but there is no debate at all about whether this is possible. It clearly is possible to write zero coupon curves, swap contracts, and clearinghouses as Solidity smart contracts. In the next video, we will look at what this means for Ethereum specifically and blockchain, Web3 and DeFi more broadly. In this video, we've looked at why we need clearing. With long-dated contracts, such as interest rate swaps, there's a chance that a party may default. If the impact of this insolvency is limited to the defaulting party only, then there's perhaps not much cause for concern. But If other firms are dependent on payments received from the bankrupt firm, then there's a chance of a cascading series of defaults and systemic risk to the market. Clearinghouses manage credit risk and serve as a circuit breaker against systemic default. They stop large exposures in the market from building up by requiring daily exchanges of variation margin. In the event of a member's default, they will neutralise the risk in that portfolio while using the defaulter's initial margin to pay for variation margin gains in surviving members' portfolios. A deep default waterfall structure, including a mutualised default fund layer, provides further protection against systemic risk. We've pointed out that all of these complex structures that often require legal, compliance, and risk oversight could all be replaced with smart contracts, where the rules are automatically executed and payments between parties' accounts are automatically made. Please join me in the next video, where we will discuss the implications of this and what that means for blockchain, Web3, and DeFi.